Would you be sitting with Mr. Diamond now saying that we can make coupon and total return now? Are we going to see price up, yield down in a basic bond portfolio?
I can't tell you how relieved I am not to hear him tell me that I should be preparing for 7%. So I'll take what I can from him, that we're due for a pause and that should relax the markets. No, 100%. This is the time where you clip coupons because yields have reset materially higher from where they were at the end of 2021. Actually, when you look at real yields in the bond market, they're the highest level going back 15, 17 years. We're going to get some capital appreciation on top of the coupon clipping. I'm looking for close to double-digit returns on the Bloomberg aggregate over the next year.
This is the key statement, and what's important about this is Mr. Diamond back to Bank One actually knows what an S&P Blue Book is. I mean, you have a Blue Book and you have bonds in it, you go through and you try to buy bonds for price up, yield down. Which kind of bonds will give you the best pop there to get your double-digit return?
Well, we're certainly intermediate government bonds look good to us. So we're thinking the 5-year Treasury. We feel we've been given a gift in here with the backup in yields. Sure, we swung a little bit low in yields. The market got all excited. Now it's going the other way. We do think that we're going to see 3% across the coupon curve by the end of the summer, and the 5-year seems to be the sweet spot. So we like that. And then we like high-quality credit. So for sure, we're going into investment-grade corporates. We're actually starting to see a lot of overseas investors returning to the U.S. investment-grade corporate bond market. They're attracted by the yields there.
The yields here, John, and it falls right into the disinflation, deflationary Chinese impulse.
Let's unpack some of this.
Huge statement.
Just on the yield curve, for people who aren't familiar with what drives different parts of the yield curve, what is special about a 5-year maturity? Why is that the sweet spot for you?
Because it gives you a couple of things. One, it gives you a reasonably high level of yield. Sure, it's not cash. Cash is sitting out there at over 5%, but that's the cash trap at this part of the cycle. You put money there, and then a year from now, it's gone. Your cash run rate is probably below 4% a year from now. So you've lost all of that, and then the yield curve starts to adjust to a central bank that's cutting rates again. We still think we're going to be in recession by the end of the year. Everything that's happened so far this year continues to tell us end of the year recession and first Fed rate cut in September. And I know the recent data throws some of that into speculation. Not in our book. Things are playing out the way they should exactly.